Five stocks to buy in the month of October 2022. This is obviously the month of Halloween. We've had some scary times in the market, but I think that some of these stocks are undervalued and it's pretty scary how well they can do in the long term. I'm going to show you exactly what I find great about these, all the reasons I'm investing in terms of value, growth, and then revenue and net income, their dividend if they have one, as well as their balance sheet. So if you're excited for this one, make sure to subscribe and let's get started. All right, guys, so number one is going to be PERI stock, P-E-R-I. The PERI stock is a value stock. It trades at a PE ratio of around 14, which is slightly under the market average for the next 12 months on the forward PE ratio of the S&P 500. In terms of growth, we're looking somewhere around 31% revenue growth for the next quarter, and they've been consistently putting up 30% plus revenue growth for the past couple of years. For net income, the previous quarter, they reported over 100%, I think around 170% increase in net income. So that is phenomenal. So not only is it a value stock, but it's also a growth stock. In terms of a dividend, it doesn't have one yet. And lastly, as far as balance sheet goes, this has one of the best balance sheets for a small cap tech company out there. So it has a current ratio of around 2.7. So it has over 2 times, almost 3 times the amount of current assets to current liabilities. So this company is nowhere near, a liquidity issue or bankruptcy. And in fact, Perion actually has no debt. So that's incredible. This is one of my number one stocks to buy. It checks off pretty much all of these boxes out there besides having a dividend, but we're looking at huge growth for the long term. And if you look at Perion's growth trends and compare it to its sector, so digital advertising is really struggling right now because of a recession. A lot of people are cutting their ad budgets, but Perion, quite the opposite, is actually growing phenomenally, faster than its peers and its industry. So just imagine how well Perion is going to do once we actually have a bull market. We trade at a more reasonable valuation. PE of 14 is insane when you consider the fact that the average S&P 500 company is growing about 3%. Moving on to number 2 in this list, it's actually not a stock, sorry, but it's actually index funds. So the ones that I like are going to be VOOQQQ for technology, and for the overall stock market, it's going to be VTSAX. Now, the reason why I say index funds are a great buy right now, most of them are down 20 to 30% on the year. If not, QQQ is probably somewhere around 35 to 40% almost. And that's one of the best times to ever buy an index fund. If you look at past recessions, like the 2008, 2009, or even going back to the dot-com bubble for tech stocks, obviously a lot of stocks went down for a long time, but over a long period of time, if you're investing and not retiring for the next 1, 2, 3, 5 years, you have a long time to go with these investments. And in the long run, all of these index funds will go up. Unless there's no stock market anymore and we're all dead, there's no reason why they're not up in 10, 20, 30 years by the time you retire, for the most people watching this video. So VOO, VTSAX, and QQQ. VOO, this one in particular has very low fees, 0.03%, something like that. Warren Buffett actually invests in this one and recommends this one. Vanguard, very great. QQQ, again, I mentioned, is technology. This one is actually still up over 80% in the past 5 years. So going back to long-term investing, right? Even though the whole market has gone down tremendously, and especially tech stocks, it's still up 81%. So if you invested $10,000 in this one, you would still have made $8,000 to date over the past 5 years. These do have a slight dividend, somewhere around 1 to 2% for these index funds. Not bad. A little bit of passive income. Index funds or ETFs, they have 100 stocks in them, over 100 stocks in them. Now, is the market overall undervalued right now? Well, the average forward PE ratio on the S&P 500 I mentioned earlier is somewhere around 15 to 16. Now, historically, if you compare that to the past 5 years average and the past 10 years average, we're now below that. So some might say it's a good time to buy. You do have to consider that the average growth rate for Q3 of 2023 is expected to only be 3%. That's one of the lowest growth rates we've had in a long, long time. But if you do believe things are going to get better in the future, this is a great time to buy these index funds when they're down so much. Moving on to number 3 is BYDDY. This is a Chinese automaker. They do hybrid and full electric vehicles, and they actually surpassed Tesla for total vehicles sold globally in this past year. So incredible. And they're also the second largest battery manufacturer in the world, and they currently supply to Tesla as well. For the valuation, I must say it is pretty high. I think it's over a 100 PE ratio, so it's not a value stock, right? But in terms of growth, we're seeing some insane numbers here. The demand for BYD's vehicles is astronomical. They just got a 100,000 order from a German car rental company. They also have over 700,000 vehicles back orders that they can't fill right now just because the demand is so strong. Now, this past quarter, BYD did 67% revenue growth and over 132% net income growth. So this is absolutely on fire right now, despite the fact that China has been under lockdown for a long time. And consumer demand there has been dwindling, but they do have electric vehicle subsidies that they're offering to consumers to try to keep up that demand. So that's one reason why BYD is benefiting right now in this environment still. Now, BYD doesn't have a consistent dividend, so I'm gonna put question mark, but I think they did pay out a dividend recently this past year. Now, in terms of balance sheet, this one is not as great as PERI. Current ratio of 0.8 there, so they do have debt on the balance sheet. If you look at the overall assets to liabilities though, it's at around a 3:2 ratio, so they do have more assets overall compared to liabilities, and they are cash flow positive and profitable, so not too worried about that when you consider the fact that the growth is insane here. Despite the huge growth though, because it has a high valuation, the stock price is under pressure during a bear market. In a bull market, this would go crazy. People wouldn't care about the 100 PE ratio when it's growing its net income and sales so much. Warren Buffett also has started to sell some of his position. He is a big shareholder in this one. He bought over like 10, 15 years ago. We're gonna see if he continues to sell those shares. I think that any downside here is a good long-term buying opportunity. And if you look at the charts, the current price here of around 48 is somewhere around that long-term trend line. So it could see a bounce from here. We'll see. Either way, I'm a long-term investor. Hey guys, if you're new to investing or just want some free stocks, check out Moomoo. This is an app that I use, and that's where all the screenshots came from in this video. With all that research, you can get up to 15 free stocks right now. Use the link in the description. It'll be in the pinned comments as well. Next up, number 4 is going to be O-Stock, Real Estate Investment Trust, Realty Income Corporation. This one trades at a very high PE ratio, but when it comes to real estate companies, you actually want to measure them by something called funds from operations. And if we do the math, it trades somewhere around, maybe around 14 times adjusted funds from operations. So a fair valuation as well, similar to PERI here. In terms of growth, this one has consistently put up 10% plus revenue and net income growth over the past several years. When we look at the past quarter, on paper, it's up 70% for its revenue and net income. Of course, it did recently merge with a UK-based company, so the results are not quite accurate here, but again, about 10% plus consistently. And the dividend is where it's most important here to talk about. It has a 5% dividend and it has consistently paid its dividend for over 25 years. And this is a monthly dividend as well. So 600 plus consecutive dividends, and they constantly raise this dividend as well. If you look at the dividend history, very, very consistent and reliable. If you look at its business model, it's built on triple net leases, so the tenants pay for pretty much everything. And this has a really great tenant portfolio made up of a lot of essential businesses. You look at 7-Eleven, Walgreens, Home Depot, CVS, these are not gonna go bankrupt anytime soon, and they will consistently pay their rent to O. And these are leases that are 10 plus years. So again, super, super reliable business. Since the stock was listed on the New York Stock Exchange, it has a compound annual growth rate of 15%, including its dividends. So your money is very safe here. And if you look at the beta as well, 0.5 suggests that the stock is also less volatile than the overall market. So you're not seeing big swings in the price of the stock all the time. So while we do have some growth stocks here, this one is mainly a stable dividend play that is going to give you some passive income to weather through the bear market. And lastly, stock number 5 is going to be F stock, Ford. This is America's traditional automaker, right? It has an extremely low PE ratio right now of about 4 here, which is well below the market average. And the forward PE ratio on the market is 15 to 16, and you're looking at a 4 for Ford. Insane. Not to mention the fact that Ford, although it is a value stock, it's also a growth stock. If you look at the huge demand for Ford's EVs, they're growing hundreds of %. And if you look at the revenue and net income this past quarter, 50% sales growth, unbelievable for a company of its size. This is a $50 billion company, guys, trading at a 4 PE ratio, growing at 50%. Are you kidding me? Ford did recently put out some bad news, to be fair. in the next quarter, they're expecting almost $1 billion more in supply chain costs with its suppliers. A lot of inflation is really bringing down that net income growth. Otherwise, we would be seeing, rockets up, billions of dollars. But I think that in the long run, those costs will stabilize. And with the huge demand, right? Tesla's not the only one selling electric vehicles anymore. I think this is gonna be huge. And they recently increased their dividend by 50%, bringing this to a 5% dividend as well. So you not only have value, you have growth. Boom. You have dividend. Boom. Finally, in terms of balance sheet, Ford has a 1.1 current ratio, so not the best out there, right? Similar to BYD, 0.8. So this is the only flaw I see here. They do carry a lot of debt, but overall more assets than liabilities. And sorry, I forgot for O stock, the current ratio here is 0.7, so it is also another debt leveraged business. But in terms of overall assets to liabilities, you have over 2x here. They have over $40 billion in assets and under $20 billion in liabilities. The way that business cash flows though, consistent rent every single month, I think that it's not a concern here. So there you guys have it. These are my 5 stock/index funds to buy for the month of October 2022. We have PERI, VOO, VTSAX, QQQ, BYDDY, O, and F. If you like this video, please give it a like and subscribe to the channel Stock Dads. I'd highly appreciate it and it helps us tremendously. Look forward to the next video and good luck investing.